All right, welcome everybody to the January first roundtable session of the year 2011. Have an interesting program today. Sai's going to spend some time talking about the longer term perspective and cycles and bubbles and how company size matters, and then we'll have a couple of stock presentations. As we warned you, Hugh McManus is having technical difficulties, and we still do not know if Hugh's going to be able to join us or not. So we'll just cross our fingers, pray a little bit, and hope that he's around here in a few minutes. We're forced to start without him, and that's unfortunate.
Mark, I'm getting a lot of questions. People want to know how many attendees we have. You can let them know that at the present time we have 50 attendees.
Yeah, in fact, I'm showing 54. Well, that counts us in the back room, I guess.
Yes, it does.
Yeah, so it is interesting. We do like to come together. Again, the purpose of the program is pretty straightforward, just to share some ideas, offer some thoughts, and I'll open up the floor for questions and answers here in a few minutes. So let's go ahead and first welcome anybody who may be new to the session. Let's spend just a moment talking about why we do this, what we're doing. Here's our agenda for today. I'll just cover some opening remarks, talk about what we've been doing for the last 6 months or so. Sai will give that big picture perspective. We actually don't have anything that qualifies as a challenge candidate. You'll see that when we take a look at the dashboard here in a few minutes, and then we will take a look at some companies that we'll be studying. And I have one selected, but I know that Ken and Hugh were both still pretty wide open, and we're not kidding. We just come together and do this somewhat on the fly sometimes. Here's our commercial announcement that covers both manifest investing or NEIC better investing. This is for educational purposes. No investment recommendation is intended, and I'm sure that everybody here has seen this at least 100 times. But again, the important message to take away is we are going to talk about real companies in real time, share our own analysis, which you may or may not agree with, but the most important thing to take away is do your own homework, make your own decisions. Here's what the Roundtable's about. We started it back in the middle of last summer. We get together monthly with my 3 colleagues. We've been friends for a long time. I have witnessed very successful stock picking and portfolio management from all of them. We just thought we would come together and share some thoughts. We don't do this idly. We actually are attempting to pick stocks which collectively will outperform the benchmark, the general stock market, by 5 percentage points over the long term. That is our goal. How are we doing on that goal so far? And this is where Sai always whispers to me, patience, patience. Sometimes it does take a while for our opportunities to germinate and come to fruition. What you see here is a rundown of the stocks selected since July. That is the average cost. That would be either split adjusted or dividend impacted cost. So yes, we do account for dividends in the selections, and since Hugh often picks dividend paying stock, he's glad to hear that. But what you see here is how each stock has performed versus the market. That's what the market return is. That is the return on the benchmark, and for the benchmark we use the Vanguard Total Stock Market Index, which emulates the Wilshire 5000. So again, we're trying to use almost as broad as you can get without making an index yourself. And then every single pick, let's start with the very top one. Back on July 30th, I believe it was Hugh, picked Lilly at a price of $34.66. It's now up to $34.77, so it actually has only gone up 0.3% during a period where the market has gone up 16.9%. And the relative return is what we track. It's just the total return on the selection versus the minus the market return. So you can see that's what we'll be aiming to achieve 5% positive over the long term. So the one we'd obviously like to talk the most about is Walgreens from August. You can see that right here because that's up the most. But at the same time, those of us in the room are honest enough to know that we also want to talk about situations like Strayer, where it's down 36% versus the market since the time of selection back in September. We try to learn from those. And you will see one position that is highlighted since we began this a few months ago. That is a sale. We'd actually had a challenge on Strayer just after Christmas, and wow, I think we're kind of glad that we backed away from half of that position. We actually left that position at 157.07, so we actually have locked in a positive 6 relative return on that one. Just a quick note about accuracy. We are shooting for an accuracy in the 60 to 70% range. That's what most of us have achieved in our long-term stock picking histories. You can see that we're just a little cold right now, but that's okay. We're within a couple percent of where we want to be, but go ahead and whisper patience, Si.
Patience, Si. No, patience, Mark.
All right, let's take a look at the dashboard. Here is the dashboard that is available on the manifest page. The Roundtable dashboard is published continuously, and you can see that we have had multiple selections. In the case of Abbott Labs, that has been selected 3 times. In fact, it's been selected by all 3 of us that are here right now at various times over the last few months. So that $3,000 is now worth $28.95, so it's down a little bit, but we continue to have high expectations for Abbott there at the top of the list. All the way down to the bottom where you can see that $1,000 invested in Strayer back in, I believe it was August, is now down to $756, but hopefully the Strayer situation is finally shaking down and we can start to believe forecasts. As one of the attendees here, Mark Johnson, has pointed out, it's kind of an amateur hour on the forecasting, and the forecasts for Strayer education have been all over not just the map, but the universe. And hopefully we'll start to see some signs of what we can expect from that business model going forward. But again, you can check the status of any of the current selections. And the reason I say there probably isn't a challenge here, unless Si or Ken wants to bring one, is that the overall portfolio looks pretty good. I mean, when your weakest component is Costco wholesale at a par of 8.5, excellent quality rating, it's pretty hard to think about dismissing that from the portfolio. So again, probably don't have anything that qualifies for a challenge at this point.
Mark, we do have a pretty good question. Dean Alden would like to know, what is the accuracy rating? Can you explain that a little bit further?
Absolutely. Thanks for the question, Dean. Hope everything's okay down there in Cincinnati. I know you guys got some snow also. The accuracy rating is simply a judgment on has the selection outperformed the market. So you can see in the case of Lilly, the very first one here on the chart, in fact I should probably get the felt tip pen out. The very first one on the chart here has an accuracy rating of 0. That simply means that our return here is negative versus the benchmark. And you can see that if you look down the list, anything that's green is going to be is going to have an accuracy rating of 1. So literally it's just summing up the ones and dividing by the total. So the accuracy rating is the amount of the selections, the number of selections that have outperformed the market since they were chosen. Another way to think about that, and then you hear me talk about this all the time, context. The average investor, when we take a look at the accuracy ratings over at the Motley Fool CAPS experiment, the average is down around 40%. So the average investor experiences about a 40% accuracy on their complete universe of selections over time. So that gives you something to put it against. And again, we're shooting for 60, 65, 70% is where we want to be on that longer term. Anything else, Ken, that comes to mind at this point?
No, that covers our questions for the moment.
Okay, with that, I'm going to go ahead and launch Mr. Lynch from Atlanta. He's going to share a little perspective on what we might look for in the year ahead and the importance of size diversification. Take it away, Mr. Lynch.
All right, thank you, Mark, and good morning, everybody. I don't know if this is the new and improved Si Lynch you have with you today, but I do have a new headphone, so maybe the sound will come through nice and clear. Well, good. That's working well. What we're going to talk about today is look a little bit into the crystal ball, as you can see Merlin or whoever that is there. I don't notice that he has a Braves logo on his shirt, though, Mark.
He doesn't.
Missed that on our guy. But here's just a good visual depiction on why size does matter or how size matters. You can see comparison between the blue bars, which is the value line, arithmetic index returns over the 1 year, 3 year, 5 year, and 10 year period. That is, of course, a mixture of large and medium and some small companies. So that's a mix of companies. You next see the Wilshire 5000, which purports to be a total market index. I tend to contend, and you can see how closely it does tend to track the S&P 500, that actually total market indexes are largely stealth large company indexes because they're all weighted by market capitalization, so the larger companies have a greater impact even on total market indexes than the small companies do. But you can see even with that, the Wilshire 5000, which certainly has more small companies than the S&P 500 has a greater return over time than does the S&P 500, and that's the green bar, which you're all familiar, I think, with the S&P 500, which are 500 of the largest companies in the United States, measured again by market capitalization, which is simply the number of shares outstanding multiplied by the price of the shares. Let's take a look at another perspective on the next slide. This is just a quick chart for roughly the last 30 years. The top line, the gold, is the Vanguard 500 index fund. That's the S&P 500 index. And the lower black line is the Vanguard Small Company Index Fund. And you can see that over the last 30 years, on a cumulative basis, the large caps have performed better than the smaller caps. So again, size makes a difference is the primary point that you can get out of this. The one thing that I will point out on this chart, and just beware of it on any long-term chart in particular, this chart would make it appear that the large cap fund, the Vanguard 500, that is the VFINX fund, is more volatile, because notice how those price movements seem larger in the upper line in, say, from 2000 to 2010 than do the price movements in the lower line, that being the black line. However, realize those are percentage movements, and for example, let's just look at 07 and 08 through 09.
Sorry.
Yeah, don't jump ahead. Since I don't have a highlighter, I can't show it. But if you just look at the peak of the gold, right in there where Mark is kind of showing, around the 800, and that dropped down below the 400, about a little over 50% drop. Show the same place on, okay, so there's about a 200% down to close to zero. So you see that movement on the black line actually on a percentage basis is larger than the movement on the upper line. So I just point that out, that in reality the lower line is a little bit more volatile. Let's go ahead to the next. All right, this just throws in the Vanguard mid-cap index, which are middle-sized companies between the large cap and the small cap. That's the VIMSX. And again, you see since the 1998 inception, so roughly the last 12 and a half years, again, large cap stocks have, on a cumulative basis, outperformed smaller caps, and then the mid-cap, excuse me, I'm sorry, I got that backwards. They changed my colors on me. Thank you, Mark, for the circle. The mid-caps have outperformed, and then followed by the small caps, and then the large cap, the blue line at the bottom, have been the lowest. All right, next slide, Mark.
Again, I think that's also reinforcement of why we say, keep a large component of your portfolio, club or personal, in those medium-sized companies.
Absolutely.
But you also got to know when to watch for overvalue conditions also. Go ahead, Zach.
Okay, and then this slide, again, I kind of grate every time I hear somebody talking about the lost decade or stocks being flat, and I, as the slide asks, where is the lost decade? I only see one lost decade on this, and that's the blue bottom line, which is running about 0% or flat, and that is the 500 index fund. So if you invested in the large companies alone, in the proportion of the S&P 500, then you would have roughly 0 annual return over the last 10 years. But notice the other two lines, the small cap and the mid cap funds, are up significantly over that decade. So again, it is all in how you look at it. Next slide. All right, here is again another example of why it's good to have a mixture of companies in your portfolio. This just moves from the March 2008 market bottom through the current price, and here again you see that large companies have lagged coming out of the bear market. That's not surprising. That's again why we teach that you may relax your quality standards a little bit, not to go into low quality companies, but just to accept a little bit lesser than the very high, tight quality standards that you would otherwise when market projected returns or MyPar are at historically high levels, as they were back in early 08. Yes.
Cy, we have a question. Is the logo or is the explanation reversed incorrectly on the graph? Is the blue mid-cap or large cap?
On this particular one, the blue is mid-cap. Thank you for catching that. I thought all but one slide was the same, and we apparently missed it on this slide. Yes, thank you, Mark. And thank you, whoever caught that question. All right, so yes, but here it's all in how you look at it. Notice I've added a different color, that being the red color, which is the rider equal weight S&P 500 fund. Remember, I mentioned earlier that indexes are almost always weighted by market capitalization. That is, the larger companies measured by market value impact the index more than small companies. The rider fund, however, what it does is it takes the 500 companies in the S&P 500 index and simply weights them equally. In other words, every quarter when they rebalance the fund, they buy roughly 2% of each company in the, 0.2% of each company in the S&P 500 and do it. And notice it has actually, since its inception, or since the market low, has done better than all indexes other than the small caps. Let's see, okay, sorry about that. My screensaver went on here and I lost my monitor. It's back now. But what that's saying again in another way is again that size does matter, because even in the S&P 500 companies, while we call them all large companies, you actually have, of course, what are frequently called the mega caps, the really huge companies, the Microsofts, the Exxons. Apple is actually quite a big one now, that are very large, whereas you have almost middle-sized companies down at the very bottom. The equal weight index weights all of those equally. So again, it gives you a better mix of companies. All right, moving on to the next slide. This is just another look. The RSP, or the RIDEX Equal Weight Fund, was started on April 4th, 2003, and you see while it does lag both the small cap and the mid cap funds over that period of time, it has done significantly better than the market capitalization weighted S&P 500. All right, let's move to the second part of today's presentation, looking a little bit at what's going on ahead. We'll continue looking at the returns by size, just again to reinforce the importance of having a mixture of company size. But I wanted to play a little bit of crystal ball and talk briefly about the presidential cycle. What the presidential cycle theory proponents say is that the first year of a presidential term, in this particular case that would be 2009 for President Obama's administration, is generally the weakest of the 4 years for the stock market. That being because both the legislature as well as the Congress as well as the President wants to go ahead and get the tough medicine, the bad news out, and so forth. So they do that early in the term. The second year tends to be a little bit better, but again, still a relatively low period for the stock market if you look at historical averages. Then around the mid-term period, everybody starts looking to get reelected, and so they start taking action that is more stimulative to the economy, more stimulative to business, and so forth. And the theory holds that that is strongest in the third year of the term. And in fact, again, looking back over just about any time period you choose and just about any index you choose, the average return in the third year of a presidential term is, in fact, on average, the best return year for the stock market. And in fact, you can see that it has never had a down year since 1939. And then the fourth year also tends to be an up year for the market on average, but it doesn't have the same up every year record that the third year has. Ken Fisher is a very strong proponent and believer in the presidential cycle, and again, as you can see, no down years in the market since 1939, and this shows the last 30 years, and you can just get a little bit of a snapshot on how each one was up each year. Let's take a look at about 4 specific cycles. Notice the real tough year was 1987, where we had the October crash at that time, and you can see that in fact the Vanguard 500 index, which on this chart from Morningstar is the upper dark blue line, finished the year up just a little bit over where it started. This does include dividends. Interestingly enough, all of the charts that I've been showing so far from big charts do not include dividends. That's fine for the purposes we've been using them, but if you actually look at 1987 on using the big charts and the Vanguard 500 index proxy, you'll actually see a negative. The stock prices in the index actually was down in 1987, but if you include total return, it was not. That's the only year that was close. Let's take a look at a few more and see the difference of size. Here's 1999, the last year, or the last term, the third year of the final term of the Clinton administration. Again, recall that was nearing the end of the large cap outperformance period, the large cap bubble, if you will. Large did better, followed by small, followed by mid cap that year. And all in all was a pretty good year for the market, with returns, at least in the large cap, exceeding 15%. All right, let's take a look at another year. Here's 03. This was the beginning of the bull market coming out of the early century bear. And here you see small outperformed, mid cap was second, and then large. And again, in these one-year periods, you can get a pretty good feel for the price volatility as well. And you can see there certainly is more squiggle in the dark black line as opposed to the blue line, which is again one reason that you like to have a mixture of company sizes in your portfolio to give some stability along with that potential higher return. All right, well, let's take a look at where we are now. And I figured let's compare this time period with 2007. Number one, 2007 is the one presidential cycle, third year in the term that we have that we can compare manifest portfolio tools with. Also, I think there's a fair number of parallels between now and 2007, and on my last slide we'll talk a little bit about that. But you can see here, just taking a look at the yellow filled in graph, the value line annual total return, you'll see it was running about 6% throughout most of 2007 versus around 8% now. My par, the same thing, running just below 8% now. Actually today it's, I think, 8.1%, but has been running right in the 8% range, and you can see was running between 5 and 6% back throughout the 2007 period. So that is essentially telling me that compared to 2007, while we are nearing market overvaluation by historical standards, the market still isn't quite as overvalued as it was back in 2007, the last third year of our presidential cycle. Let's take a look at what happened in 2007.
I would like to just say, that's a great slide. I mean, one of the things we've talked about in the community is we had that, you know, kind of flat spot where the prices were elevated for an extended period, this whole extended period, you know, and history told us that that should have, you know, led to a correction earlier, and it didn't. And what you're showing us here is that the presidential cycle, it may have been part of that mystery that we've been kind of kicking around for a while. Very fascinating stuff, and it's good information for this year. Go ahead, sir.
While we've paused, Dan Hess has a question that maybe you can respond to. Dan would like to know if there's ever been anything done showing the relationship between MyPar and value line and comparing it to the third-year presidential cycle.
To my knowledge, Dan, other than the slide that is currently on the screen and then the one that we're going to flip up in just a second, no. And as for MyPar, of course, those would be the only two comparisons we could have, that being 2007. In preparing this, I thought about maybe getting some of Mark's longer-term VL map charts and then taking a look at them and seeing. But of course, you'll recall we've refined that analysis quite a bit in the last few years. But I think that's a good question.
We could perhaps go back to 2003 with the value line low total return forecast.
No, okay.
So we could get another presidential cycle. Go ahead.
Cy, we also have a question from Norm. Norm, I'm going to unmute you. Go ahead. And it appears that Norm is still having audio problems. I'm going to put him back on mute and take his hand down. Cy, that's all the questions at the moment. Go ahead.
All right. This is what actually happened in answer to Dan's question in 2007. And this does show also the rider equal weight S&P 500 fund, which you see, interestingly enough, over the year as a whole, did just about the same as the small cap fund, did significantly less favorable than the large cap fund, that being the VFINX with the market capitalization. Now again, that's beyond the scope of today's presentation, but that's actually not unusual. The equal weight fund tends to do better when smaller companies do better. The market capitalization version of the S&P 500 fund tends to do better when larger companies are favored. And 2007 was a period at the end of the bull market when actually large cap companies tended to do quite well relative to their smaller compatriots, as again this chart shows, the gold line being the large cap market weighted fund, which did end up doing a little less than the mid cap fund, which is back to what Mark was mentioning earlier, that middle-sized companies are a very strong and important portion of a portfolio because they do tend to perform well in a number of different conditions. All right, let's kind of wrap up for what maybe this means. Next slide. As I mentioned earlier, I see some parallels between now and 2007. Not perfect, but we're in a period of economic uncertainty, questioning double-dip recession at this time versus, of course, entering a recession in 2007. We again, for the first time in this presidential term, have a divided government with various parties in control of the two houses of Congress and then the Democrats in control of the White House. We've looked at the MyPar comparisons, actually a little bit higher right now, so at least on a long-term perspective, a little bit more potential return looking out. And then the takeaways that I get is certainly stay invested. Again, if you believe in the presidential market cycle, this is going to be not a loser year and potentially an up year for the stock market. Size certainly matters. Stock selection matters. Again, that's something we'll spin out a little bit more on the equal weight versus market capitalization weight, perhaps in some forum posts and maybe articles going forward. But the lack of correlation between those two shows that stock selection does matter. And then with MyPar running less than 10% and bumping down toward historical levels, we certainly want to continue our stress and maybe tighten up a little bit more on our quality picks. Thanks a lot, guys. I went on longer than I'd planned, but hopefully it's been worthwhile. So.
I think it is worthwhile. In fact, I wanted to take just a second and just kind of explain. Some of you have been curious about what are we doing with the balanced investing stuff that we're exploring right now, and why are we doing it? Let me just give you a quick nutshell. I think, and I'm going to use this slide to frame it, I agree with Cy that there are some parallels back to 2007, and I think the stuff that we're doing in that realm of understanding probably parallels what we did with the triple play back in the bottom of the correction or the bear market. And what I'm talking about is here. You know, we reached a peak mid-year back in that last presidential cycle, and then we basically went south. In fact, Halloween of that year was the beginning of the Great Recession. And basically what we're doing with that balanced, or it could be construed as perhaps a little bit more advanced investing type, bigger picture type investing things with asset allocation, you know, how much cash makes sense, even some protective or conservative options strategies, and that type of stuff. The reason we're doing that is we see the potential for this type of thing to take shape again, and we're just wondering, could we put ourselves in position to preserve capital and be protective next time around. So that's why you see us dabbling in those areas, trying to understand them as a community better than ever. So thanks, Cy. Awesome presentation. You certainly didn't go too long. Let's put just a little commercial break in here for those of you that are affiliated with investment clubs. Just want to make sure that you understand that we have, probably for the first quarter of 2011, a special offer out there that every member, every partner within your investment club can access Manifest Investing for $169. And if you want to know more about that, you can send me an email. My email's at the bottom of the chart there, but the bottom line is every partner gets access. We're going to be doing more club-related stuff. Ken does a lot of stuff with portfolio-centered decision-making with clubs that he works with. If you're interested, let us know. And one of the what-ifs that we get, what if you're already a subscriber? We extend the existing subscriptions by a year, so everybody gets a one-year period using that one-time group price at $169. So again, if you have any questions, just send me a note.